In a surprise move, the Chinese government has come out and devalued their currency, and that has caught a lot of investors off guard. Here to give us some context and what it means and perhaps what it doesn't mean, I'm joined by Beata Caranci. She's Chief Economist at TD Economics. It is great to have you here.
Well, thank you.
Okay, so I'm just going to start with the sensationalistic side of things. They made this announcement. We saw market sell-off, we saw individual stock sell-off, and headlines were blaring everywhere. Why are we seeing this reaction?
Well, one, it was a surprise announcement, as you indicated, that wasn't well telegraphed in terms of their intention to devalue the currency. And in fact, if you looked at what the Chinese currency was doing relative to others up until now, you have the euro relative to the US down, 15% or more. Same with the Canadian dollar, the yen as well. The Chinese currency did not. They actually have been holding the line and maintaining a very strong currency. And so this sudden devaluation sent a signal to the markets, or maybe an interpretation of the markets, that perhaps their economy is doing weaker than they expected, or that they can even prop up through fiscal and monetary stimulus, and therefore they've pulled the pin on the very last resort, which is, let's go back to the old model of export-driven growth. And then this sent a little bit of fear. One, China is doing worse than potentially they've admitted to doing.
Right, so we see the growth officially at, whatever percent, 7%, but maybe it's actually lower, and
exactly,
so let's do something.
Exactly. And that it triggered, a knee-jerk fear-based reaction in the markets. And then you're seeing, of the currencies that the Chinese currency has held up really strong to is its major trading partners, which are predominantly Asian countries. So a lot of the adjustment that you've just seen in the markets is occurring against Taiwan, South Korea, and other countries like that, as opposed to Canada, Euro, Yen. Those currencies are holding up relatively even, whereas the others are appreciating strongly relative to the Chinese currency now.
So let's talk a bit, because you and I had a fascinating conversation before the camera was turned on, in terms of interpretation. Markets are going to interpret how they interpret, but we have had a lot of not so great economic data out of China, and I see pictures circulating about electricity demand, which is falling off, and shipping volumes on ships falling off, that kind of thing. So we're not denying that things are slowing down in China, but the other thing you mentioned is what China's aspirations are from a currency perspective with the IMF. So what's actually happening there?
Right, so around November, the IMF is going to do a review of which currencies to include in, it's this de facto currency they have is in terms of a reserve currency, and it's called SDR, Special Drawing Rights. And it's an elite group. There's 4 members represented. You have the US dollar, the euro, the yen, and the pound. And China would like to be considered as the 5th member in that basket. And that gives a lot of legitimacy to China in terms of the financial markets, the convertibility of its currency, the use inside global markets, and can accelerate the use of it as a reserve currency internationally. Now, SDRs are not used widely. They only make up 3% or less of reserves, and they're only transacting between government levels. So it's not about really, this is going to change the landscape. It's more a level of prestige, acceptance, and the signal it sends to markets in terms of the validity of the currency and its wide use.
We're willing to be participant in market forces.
Yeah, and that they're succeeding in liberalizing their financial markets, and it's getting recognized by the international community.
Now let's join those two together. So let's say they have a plan, and part of the reason we're speculating is because it's not the most transparent organization to try and find out information from, which everyone struggles with. But they have a plan to get into be a reserve currency. Perhaps could that have been accelerated a little bit given the economic situation in China? Yeah,
so on the one hand, the market's saying, well, the timing is rather suspicious on the devaluation, because it's not coincidence that their trade numbers are showing that their exports are down 8% relative to a year ago. But at the same time, they're running out of runway to show that they're liberalizing their foreign exchange markets for this evaluation by the IMF to include them in the SDR. So it's possible they may have been intending to do this down the road anyway, but the runway was shortening up and they decided to pull the trigger on it now. The IMF has actually endorsed the move by the government to do this, moving their fixing rate closer to the market rate. So to try to probably quell some of the speculation and to indicate that, yes, this is a move in the right direction.
Let me ask you about 30 seconds left. So I'm an investor. I'm watching this, and again, I know you're not going to give investment advice, so stock market outlooks, but China is doing this. Do we expect more Could we see more moves like this in the future from China? And what should we be looking at or thinking about or listening to when it comes to China in the next little while?
Well, given that they're sending a strong signal that they want their currency to move more in line to the market sentiment as opposed to them fixing it to where they think it should go every day. It tells you that if the market sentiment remains negative on their currency, that it will have a slow depreciation. Now, we also saw them intervene on day 2 because we don't want it depreciating 2% a day. Do the math, doesn't take long until you have a massive currency shock being absorbed. So they're trying to signal that yes, we will allow it to have this float to some degree, but it has to be controlled and it has to be orderly. And so when we saw the second day another 2% sell off, because that's within their trading range, we saw the Chinese government step in and try to prop it up a little bit as a signal to the markets. But I think the longer term trend is what we're talking about here, and that tells us that the Chinese currency is probably too strong relative to its trading partners. It's held up more strongly than many of the other currencies. So I would expect it to have a slow crawl down as we go forward.
Which has real impacts for a lot of exporters, North American exporters or companies there, which we've actually seen in the stock prices. Yeah. Beata, always a pleasure. Thanks so much.
My pleasure.
Beata Caranci, Chief Economist at TD Bank Group. I'm Kim Parley. Thanks so much for watching.